Good morning, everyone, and welcome to our 2025 Global Market Outlook, the Mekkazilla moment. My name is Cousley. I'm the Senior Investment Strategist for Asia Pacific, and I'm delighted today to hand you to a panel that includes Andrew Pease, our Chief Investment Strategist, Paul Eitelman, our Chief Investment Strategist for North America, and John Eggins, who is our Head of Portfolio Management. Now, you'll notice that two of the three have Australian accents, so we have a really good representation of our region on this global panel. You will notice in the bottom that there is a button to submit questions. So if you have any questions throughout the panel, please feel free to put those through and we'll make sure those are answered. I'll be back at the end to provide a wrap and provide a view on what this actually means, or what the global market outlook means for Asia Pacific and how we're seeing the region more broadly. But with that, Andrew, the Mekkazilla moment, it's a very interesting title. Can you give us a sense of what it actually means?
So these reports, these things like these global market outlooks, particularly the year headlines, they're big set pieces for asset management firms like us, and they're meant to give us sort of an insight into the themes that we're thinking about, and also give some extra depth into how that affects how we think about portfolios and portfolio risks. And so the title is important, and we do put a lot of time into coming up with the title. And I suppose when we got to the Mekkazilla moment, and I thought, like, one of the images that really struck me in 2024 was watching in October that amazing video of the SpaceX booster rocket coming back to Earth and being caught by those robot chopstick arms. And when I found out that that thing was called the Mekkazilla, I thought, that's it. That has to be the title of our global outlook. And it sort of works on a lot of different levels. And one thing which sort of people thought that this was going to be a really hard thing to do. So it has this idea of the improbable becoming possible. And that just fits into the theme of what we've seen so far this year, particularly in the US. So we began the year with the Fed has the tightest monetary policy since Paul Volcker was chair. We had a deeply inverted yield curve. So it was pretty easy to be pessimistic about what was to come ahead. But we've had the US economy punching out above trend growth, and we've had the S&P 500 showing over 20% returns this year on top of last year's big returns. So that's become possible. And then I like this idea of, what it shows is the possibilities that technology are opening to us. So this whole thing about this amazing image of this rock just shows we're in this amazing era where technology is opening up at a more rapid pace than we've ever seen before. So I'd like to sort of emphasizing that we're optimistic about the future and we're optimistic about what technology can deliver. And the final thing, which I thought the Mekkazilla captured, was this gentle capture of the rocket. It was just a nice metaphor for what we think is the likely outcome in 2025 is that the US economy has a soft landing. So I like this title because I thought it operated on multiple levels and it sort of captures a lot of the discussions that we're having internally. And I think it backs up. And I feel quite optimistic about the medium term. And I think this technology is opening up a lot of opportunities.
Yeah. Thanks, Andrew. I have to admit, I hadn't drawn the full connection to the soft landing just yet. So I appreciate that metaphor there for us. I might turn to Paul now, if that's okay. So Andrew touched on a couple of these things at the high level, but I was wondering sort of two things from you. Could you dig a little bit into your outlook for the US in a bit more detail? And then in particular, what are you focused on in terms of potential policy changes, especially with the new administration coming in?
Yeah, absolutely. I think in terms of the U.S. outlook, Andrew hit it pretty nicely, where our central expectation is that the U.S. economy is on track to achieve a soft landing in 2025 and deliver something like 2% real GDP growth. And that'd be a really phenomenal outcome. We haven't had a soft landing in the United States for almost 30 years. These things are pretty rare and hard to achieve, but I think we're seeing important signs of resilience. A couple of things stand out to me. Number one, around corporate earnings, the picture there has been pretty healthy and actually inflecting positively over the past couple of quarters, where we've just wrapped up the third quarter earnings season in the US. Large cap results are pretty strong at almost 10% earnings growth, which is nice to see. Arguably, even more important than that, we're starting to see a broadening out of earnings growth to companies that had really been struggling for most of 2023 and into early 2024. So, for example, small cap went through an earnings recession, a lot of challenges from high interest rates and lackluster demand in the third quarter. Small cap is also transitioning back to positive earnings growth again. And so I think that's quite important for two reasons. First, obviously, that's more fundamental strength to support the strong gains that we've had in markets that Andrew talked about. But it also offers resilience back onto the U.S. economy as well. If you're thinking about the labor market in particular, this idea of corporate resilience and strength should prevent and protect us against a layoff cycle and the risk of a recession, at least in the very near term. So I think that's been a very important positive dynamic in the recent period. On top of that as well, we have the Federal Reserve now finally cutting back on interest rates, taking them back down from those very restrictive Paul Volcker type levels to more normal policy setting. We think that continues gradually into 2025, where we're thinking a terminal rate on Fed funds could be somewhere around 3.25% on the year ahead. So directionally a view towards lower interest rates. So I think the macro picture looks pretty healthy here. From a markets perspective, though, it's been an incredible rally now for 2 years in a row with 20% plus gains from large cap U.S. stocks. Equities and credit spreads are looking on the more expensive end of history now. And so I think that buffers against some of the optimism that we're seeing from a fundamental perspective. You asked about the policy watch points as well. For me, there's, I think, 4 key focus areas from the new Trump administration going into 2025. 2 of them are market friendly and 2 of them are a little bit more market unfriendly. On the positive side of the ledger, there's the possibility and prospects of corporate tax cuts, but also a push towards a more deregulatory agenda for sectors like financials and energy that could support both the economy and markets in the year ahead. But there's also more growth negative policies being discussed and even threatened ahead of Trump moving into the White House. There have been tariff threats against the U.S.'s 3 largest trading partners already, and the possibility of restrictions to immigration and potentially even mass deportation. So a lot of uncertainty there from the policy angle as we move into 2025. And we frankly don't know which of these the Trump administration are going to emphasize into the new year. I'd say from a baseline perspective, leaning on what we learned from Trump's time in office 4 to 8 years ago, there was a lot of emphasis on putting in place policies that supported a healthy economy and a healthy financial market. So our expectation is for a soft landing where the economy and markets can keep grinding forward here, but certainly some risk and uncertainty around how these 4 initiatives evolve into 2025.
I was wondering if you could tease out your views on inflation with some of those cross currents, especially sort of impact of tariffs, and how close are we to what the audience thinks?
Yeah, I think without the added layer of uncertainty from Trump's victory, we thought inflation was on a path to moderate towards the Fed's 2% target by the end of 2025. But there are some new wrinkles there. Both the prospect of tariffs and immigration restrictions would directionally be a bit of a supply shock on to the U.S. economy and arguably increase inflation somewhat. We've modeled in about a quarter of a percentage point boost to core inflation towards the end of the year on the back of those policies. In our view, that still nets out to a picture of inflation that's moderating over time, but a little bit more slowly than what would have otherwise been the case.
Okay, yeah, no, great, thank you. Let's go around the grounds outside of the US. So Paul shared his views on the US economy around some of the election outcomes, possible policy. But what are you thinking about when it comes to areas like Europe, like China, and the rest of the world?
Yeah, so thanks, John. I'll do a quick whirl around the other parts of the world. Essentially, the theme that's been in place since the pandemic has been US exceptionalism. The US has been the strong performing economy and the others have been pretty laggards. And we know there's a lot of structural issues in the rest of the world. And it's hard to see that theme being broken in 2025. So let's move to Europe. Europe has got a lot of structural problems. The German economy has shown zero GDP growth since before the pandemic, since the end of 2019. So they've got challenges, high energy costs, bad demographics, no productivity growth, political instability. The government has just collapsed there. One of their big customers, China, is in trouble. And at the same time, China is also competing with Germany up the value scale. Their manufacturing industry, their famous automobile sector, hasn't transformed to electric vehicles. They're in trouble. France has got a lot of political instability as well right now because it's facing budget issues, which is the one thing Germany hasn't got. So it's really hard to come up with a particularly strongly constructive view about European growth in 2025, apart from the fact that the European Central Bank is likely to be the most aggressive easing central bank of the G7 central banks in 2025 because they're dealing with those particular headwinds. Move over to where I'm located in the UK. It's been a tough environment as well since the end of the pandemic. Germany is the only economy that makes the UK look like a powerhouse right now. Basically, in that list of economies, the UK is the next one up the level. And the UK has got a problem with inflation. The economy's not growing much, but inflation has been much stickier here than in other G7 economies, which is limiting how much the Bank of England can cut interest rates by. Now, we just had a budget with the new government here. Rachel Reeves, the new Chancellor, pushed up taxes a lot, but also pushed up spending by more. So there is a bit of budget stimulus. So the economy is probably going to grow a little bit faster next year than this year. But it'll be interesting to see how much the Bank of England can cut rates and whether inflation can come back down. So it's going to be a slow haul for the UK. Then if we head across to Japan, Japan has been an outlier for a long time. When everyone else zigs, Japan seems to zag nowadays, and that's going to be the case again. The good news on Japan is they are now getting into a virtuous wage price cycle. We haven't seen that for 30 years. For 30 years, the story in Japan has been disappointment, deflation, bad economic growth. We've had the topics punching out some pretty good returns this year. And we've also seen that inflation is moving towards 2%. Inflation expectations are starting to move higher, which means that, again, in contrast to everywhere else, the Bank of Japan is probably going to be raising interest rates through 2025, and they may get rates up to 0.75% or 1%. These are numbers that haven't been seen for 30 years. So that's going to be very interesting. So Japan is normalizing. And the other implication of that is it means that the yen, which is super cheap right now, if you've traveled to Japan recently, you'll know how cheap the yen is. That has probably got a lot of upside potential. And finally, there's the China. And China's the biggest question mark of them all right now. And we know that China's been in disappointment. We've been waiting for the last 2 years, it seems, for a big stimulus package to get the Chinese economy out of its property problems, out of its overcapacity problems. The Chinese economy is probably in deflation now. The GDP deflation has been negative for about 3/4. The CPI has been dipping in and out of negative numbers, with probably what economists call a liquidity trap, where monetary policy really won't make much difference anymore. And China's problem is it produces too much stuff. And that was fine when it can sell that stuff to the rest of the world. But in the world of Donald Trump, it's going to be very hard for China to shift its surplus production offshore, which is why the economy is deflating so much. They don't consume enough. So we're waiting for that to change. We're waiting for the Chinese to pivot towards a better a stimulus that's more focused on consumption. And the other issue for China, of course, is their target number one for Donald Trump's tariff regime. So again, it's hard to get really optimistic about China from a macro sense. The consensus is they can do about 4.5% GDP growth in 2025, which will be a bit of a slowdown from 2024. I think that's the case, but there are clearly downside risks. But the one thing we know about China is if the downside risks become material, the government does have the potential to do a big stimulus. So on balance, it does look like the US economy remains its number one ranking next year. And there are some significant challenges still in other parts of the world. But I'd say Japan is the one to watch out for in terms of positive surprise.
I think as you were talking there, I was wondering if you could sort of elaborate just a little bit on you went around the grounds on the economic cycle in each of these different regions. We often talk here about unsustainable extremes as the barometer or the bar for whether there's actually an opportunity in asset classes based on those views. I was wondering if you could sort of share, based on all of those and what you see in valuations and sentiment, whether there's a sort of material tactical opportunity across the different regions there.
And the point about unsustainable extremes is right, because as you know, John, being head of portfolio management, how we run our portfolios is they're very risk controlled. So we have ranges in which portfolio managers can operate, which are very risk controlled, where we do normal dynamic balancing around portfolios. And there's some of those opportunities right now, but the really big ones when we see things have gone too far and when markets are no longer efficient, because they are pretty efficient in a macro sense most of the time. There's not many of those opportunities right now. And the one that which is looking the closest arguably is the yen, but the yen has been so cheap for such a long time that it's hard to see when that will materialize. But certainly that's the one which probably does create the greatest opportunity. But apart from that, there are some good opportunities. We can see, like for Europe right now, for instance, the multiple European shares, Eurozone shares are trading on around about a 12 times multiple now, compared to around about 22 times for the S&P 500. This is the biggest valuation gap since the Eurozone was formed. So this is a historically wide discount that we're seeing for European shares. So that's a potential opportunity right there. Whether it materializes in 2025 or not is a harder call to make, but that is one which I think is quite interesting. In the UK, the valuation gap isn't nearly quite as good, but UK is operating like a good value stock, offering you a very high dividend yield right now. So you're getting a 4% dividend yield on the FTSE 100. And the other one to keep an eye on, and I think people get surprised when you tell them that the MSCI China Share Index has delivered over an 18% return so far this year. And it's something we talk a lot about with the emerging markets team, which is that, yes, there's a pretty questionable macro story for China right now. Lots of challenges, lots of headwinds, but there is a really nice corporate governance story that's unwinding in China right now. And really it's around buybacks. So for years, for the last 5 years, Chinese companies, the MSCI China companies in general, have generated profits. It's about companies in China make money. But because they've been diluting, because there's been so much share issuance, that's been taken away from shareholders. So earnings per share has been negative. Last year, for the first time in memory, share issuance in China went down, which meant that earnings per share growth was higher than total earnings growth for the MSCI. I think in the year of November, earnings per share growth was around about 11% for MSCI China, which is great when you're trading on a multiple of 10 times. So that's the thing I think is interesting about China right now. And we're seeing companies like Alibaba do share buybacks now. So if we see that continue into 2025, I think that creates a very interesting dynamic in that market as well.
Okay, no, thank you very much. We're getting a couple of questions coming in. I'd encourage people to continue to submit those as well as we go. I think what you were just sharing there, Andrew, is probably a great chance to shift to Paul. I think Paul, Andrew was sharing some views around the sort of the macro scene globally and opportunities across markets and currencies. I was wondering if you could talk a little bit about other areas that are active in our discussion debate with the strategy teams right now.
Yeah, there's not a lot of really big extreme dislocations that we're seeing in markets. As you and Andrew were describing, there's a little bit of a tug of war here between some better fundamentals in the US, but more commanding pricing in the US. But I think hot topics of discussion right now within the equity market, small cap stands out. That's an area when we look at relative valuations, for example, we're seeing some of the starkest discounts to mega cap stocks since the late 90s .com boom. So from a valuation perspective, small caps attractive. As well, one of the things we're seeing both from a macro perspective and what we're hearing from some of our money managers is the possibility that some of these policy changes into 2025 could benefit small caps for a couple of angles there. If we move into a riper mergers and acquisitions environment, that could benefit small caps in terms of their valuation multiple, if they're buyout targets. So that's one area. A deregulation agenda, particularly for small cap financials and regional banks. If we step away from some of the provisions that have been considered around the Basel III endgame for regional banks. That could be a positive as well. So I think small cap is an area of discussion around whether it warrants an incremental add in consideration in portfolios. I mean, it's a delicate balancing act.
Can I interrupt you there? Because our audience is evenly split there on small cap. So we asked them whether they thought over the next year there'd be better opportunities in small cap, large cap, or real estate infrastructure. It's exactly a third. So I'll let you keep going, but I thought that was an interesting observation from the group.
Yeah, I mean, it's a tough call because it also exposes you to some concentration risk, as you know as well, right? So if you take a position into small caps, it's an implicit bet against the Mag 7. So that's I think a key area of ongoing debate between the strategy teams and the PM groups. On fixed income, we continue to like curve steepeners in the US. So that's a preference for the 2-year point of the curve relative to the 10-year. We just think that has a lot of nice diversification properties for portfolios in a central scenario in which the Fed is cutting interest rates. We think the yield curve should steepen a bit over time, but it also hedges nicely against 2 alternative scenarios. So in an economic recession type environment where the Fed would need to cut interest rates very aggressively, we think a curve steepener position could benefit in that kind of world. And also around some of the policy risks into 2025, if there's challenges at the longer end of the yield curve, whether it's due to attacks into Fed independence or a very aggressive fiscal plan from the Trump administration that caused more of a bear steepening of the yield curve, steepeners could be useful in portfolios for that environment as well. The final one that I'd touch on is credit markets. Particularly in the investment grade space right now, we're seeing credit spreads close to the tightest that they've ever been. And so there's some rationale for that. We've talked about how the economy is performing well. Earnings have been okay. Corporate balance sheets look pretty healthy. But there's just not a lot of risk premium being offered there in the event that something goes wrong here. So particularly from a medium-term perspective, I'd say credit's looking a little bit more unattractive right now. So yeah, those are the sort of 3 key focus areas for us right now.
So why don't we turn the tables now, and I might ask John a question as the head of portfolio management. So we've spent the last 20 minutes talking about the economy and markets from the strategist perspective. So John, what is your team doing with this information, and how are you setting up for 2025?
Yeah, thanks, Andrew, for turning the tables. The outlook you've just shared, what I'd like to share is for the audience, when you go and look at the global market outlook, Paul and team have done a great job of articulating the different US policy responses and what that might mean for different asset classes, US large cap, small cap, private markets. That's my sort of beginning starting point on how the outlook translates into potential asset class opportunities. I'd also emphasize, as you did, Andrew, that without any material unsustainable extremes, our general philosophy recommendation to clients is to stay close to your strategic asset allocation and to make sure that stock selection really drives outcomes. So those are the 2 big themes that I'd recommend. Linking to what Paul just shared, though, within equities, we do agree. I think that the small cap opportunity is becoming increasingly attractive, especially if you're deploying it via active management. We're seeing some of the dislocation around the uncertainty following the election is creating opportunities for active stock pickers in the small cap space. As you were sharing, and there's examples in software for growth managers, for example. There's M&A targets, for example, in the financials, industrials areas. As you were sharing, Andrew, we have very modest exposures on things like regions and currencies for all of the reasons both of you have shared. Material cross currents between the cycle and the valuation stories there. So we're not positioned heavily. In fixed income, we do have that steepener position embedded across the portfolios. We like its diversifying nature. We like, as Paul shared, that it has the ability in multi-asset and fixed income portfolios to be beneficial in multiple scenarios. And credit is the one that we keep thinking about a lot. I think, as Paul said, extremely tight spreads. if anything, we're at the lower end of our preferred or the typical ranges on credit exposure across the funds, across the portfolios, but we're not yet there on thinking it's an outright underweight that you want to take because we're not quite at that unsustainable extreme point.
So just to follow on about the point you made earlier on, because the big issue for the last 2 years has been concentration. We've seen it in the US with the Mag 7, we've seen it in other markets as well. We're seeing it in EM with TSMC. It's a big issue about the divergence between alpha and beta. So
yeah,
where are your thoughts? Like, it's been going on for a while. What are your thoughts about where concentration tracks over 2025, and what does that do to the active investment opportunity next year?
Yeah, absolutely. Two interesting things. I keep an eye on these surveys and questions. So someone definitely asked our view on Mag 7 concentration, and someone actually shared that that, as you were sharing, Paul, that smaller cap companies that are more domestically focused could benefit in the year ahead versus large cap companies. That would clearly be one potential catalyst for concentration declining. I don't know if it's what you shared, Paul, but that equal weight across large cap, small cap, and real estate, someone else voted, and now small cap's marginally in the lead. And the reason for sharing that, Andrew, is I think when it comes to market concentration, it has been genuinely extreme. I remember sitting in these conversations in 2020. It doesn't matter how you measure it. The market looked extremely concentrated then. I remember thinking, I can't believe the market is as concentrated now in 2020 as it was in the tech bubble. We have dwarfed both those numbers, both those levels of concentration over the last couple of years, both in terms of the level of concentration and the speed with which that increase has happened. That has resulted in a very challenging active management environment across US large cap, across global equities, and everywhere. So in our view, there's two things that we keep thinking about. One is, if you have a multi-manager, multi-strategy approach, and even with sort of dedicated risk sleeves to help plug the gaps versus a typical active manager's underweight to those names, that's allowed you to sort of stay in the game, as it were, through what's been this truly historic period of increasing concentration. But at the same time, our research indicates that as markets broaden out, and you don't even need the concentration to come down, it can just flatline. And if that's the case, you see a material tailwind for active management, and we think our portfolios are nicely positioned for that. I'll finish with this explicit question was also asked of the audience. Do you expect market concentration to lessen? Most people said no, but it was pretty close, 56% to 44%. Timing this, when it might happen, is extremely difficult. But at the margin, we do think there's opportunities for things to, at least the concentration, to taper off, and for active management to benefit as a result.
Yeah, John, maybe I was hoping I could ask you one too. We've talked a lot about the public markets so far, but how are you thinking about this outlook in the context of portfolio views and portfolio construction towards opportunities in the private market space?
Yeah, it's a really interesting time, right? Where I think we shared in the global market outlook that that over 40% of the capital raised, for example, on AI opportunities, has come from venture capital, so outside of the public markets, in recent times. And it's also the case, as I look at that indicator page that you put together, if we have sort of more stable interest rates, easing regulations, lower taxes, rising M&A activity, that does feel incrementally positive for private assets, private equity, for example. We've seen a big influx of capital though, and so I think you want to be pretty careful and cautious where you place your bets. We see some opportunities outside of the US, more so than just inside of the US, if that makes sense. And there's sort of two themes on private markets that I think are worth sharing from a total portfolio perspective, that resonate or rhyme with what I was talking about on the market concentration point. The first is getting access to sector specialists can be really powerful. Not just the largest asset allocators out there. And as a result, in our view, a multi-manager approach can be really quite powerful. And the second is, it's increasingly important to have transparency and a view on the overlap and the diversification potential between public and private markets across all of the different asset classes: equities, credit, fixed income, and infrastructure. In our view, if you're properly integrating the two, you've got a better chance of building a truly diversified and resilient portfolio that helps with all of the uncertainty across currents that we've seen as well.
Perfect. Thank you, John, and the panel. That was really great overview of the the global picture. So now let's bring that closer to APAC and what does that mean for the region? So there's a couple of key takeaways that Andrew went through. The first is on China, which is very important for our region, where there are still headwinds to growth, but there is still the lingering possibility that we get a more forceful stimulus measure through 2025. The second thing Andrew mentioned was the Japanese yen. The Japanese yen continues to flag as one of the cheapest currencies of the G10. And we are seeing slight signs that there is some oversold sentiment coming through, but we haven't reached that unsustainable extreme. If we talk about Australia, we think that growth in Australia is going to be sub-trend. It's quite a soft outlook for Australia. What we will see, though, is interest rate cuts coming through, starting, we think, at the end of Q1, but it'll be quite a gradual process. So we're thinking quarterly rate cuts rather than anything quicker. In New Zealand, we are starting to see early signs that the economy is seeing some improvement following the rapid rate cuts that have occurred from the Reserve Bank of New Zealand. We don't think that rate cutting cycle has finished yet, and we expect further rate cuts into 2025. For Japan, we think the economy is still in quite a good place. Consumption has been improving, and the other part that is really encouraging has been capital expenditure. So capital investment in Japan has been catching up after years of not much activity. The final thing to note about Japan is that Japanese corporates continue to improve their corporate governance, and we're seeing that come through in measures like return on equity. If we look outside of the big Asian countries or Asian economies, we look just more broadly at the region, within the region is actually in quite a good place. We're seeing easier monetary policy that is coming through in many nations. And secondly, we see generally the growth impulse is still quite positive as a result of that capital expenditure plans that is coming not just from Japan, but from other countries, as well as tourism that is still quite prevalent. The big watch point for our region is going to be what happens with China. Do China get a more aggressive stance coming from President Trump? How do they react to that? And the second thing is, do we see these stimulus measures coming through? Because that will be not just a boost to the Chinese growth outlook, but also to the broader region, given the interconnectedness of our region. So with that, I think it's been a very interesting year. We thank you for your time. We thank you for listening through this global market outlook. We hope you all have a great holiday, and we look forward to speaking to you in 2025.